Resurgent India Knowledge Series presents live webinar on Private Equity, PE, Venture Capital, VC, 2025, Current Dynamics and Future Outlook. Moderator Mr. Gaurav Rothan, Associate Vice President, Resurgent India Limited. Eminent speakers: Ms. Taleen Sharma, Founding Partner, Green Artha; Mr. Harsh Shah, Head of Equity, Asia, Auco Credit; Ms. Deepti Agarwal, Associate Vice President, Impact Investment Exchange.
Are we live? Good evening, friends. I am Gaurav Rothan from Resurgent India. I would like to welcome everyone and thank you all for joining in for today's Knowledge Series webinar of Resurgent India. This session is going to be on private equity and venture capital in India, the current dynamics, and the future outlook. I would like to first and foremost thank the Resurgent India team for giving me this opportunity to host this webinar. Simultaneously, I would extend my heartfelt gratitude to the esteemed panel of speakers for gracing this webinar with their presence. Today, fortunately, we have a very decorated panel of speakers, which is an excellent mix of private equity and venture capital investors that take investment exposure not only in India, but also globally and across different sectors. In this webinar, we will try to unpack some of the key market dynamics from 2024 going through early 2025 and try understand the evolving investment and exit trends and look ahead at what's in store for us for the remainder of this year and beyond that. Can we have the first slide, please? I would request you to have it on full screen, please. So for the roadmap for today's session, we'll start with an overall market overview, then move into detailed sections on investments, exits, fundraising that has happened, and the sectoral performance overall, and conclude with focused insights on BFSI and climate tech, and what will be the broader outlook for 2025. So as we can see on the first slide, essentially 2024 has marked a recovery phase after 2 years of contraction, with the total PEVC investments rebounding to 43 billion, which is a roughly 9% year-on-year increase. As per certain reports, this is around a 60 billion kind of a number with around 1,595 deals. And some say it is around 43 billion. And then there is another report which says it's around 56 billion. So roughly the range is around 43 billion to 60 billion. So VC funds are the ones which drove most of this bounce, growing 40%, while PE held steady. Buyouts were largely forming the major part of the deals, roughly around 51%. We also saw India strengthen its position as the second largest PE/VC destination in Asia Pacific. Jan 2025 had a strong start, whereas March and April has been moderate. The number of deals across March and April seems to be flattish, roughly around 180 deals, and exits are down in 2025 first quarter. Next slide, please. So we will be covering investments. Yeah. So as I mentioned earlier, there has been rebound in the VC segment, VC and growth investments have jumped from 9.6 billion to in 2023 to 13.7 billion in 2024. So the deal volumes have largely been rising both in terms of quantum as well. While the number of mega deals that are there, which are like $100+ million deals, this has increased from 15 to 24. Yeah. But at the same time, the average deal size is something which has fallen by roughly 20%. So this reflects largely on the valuation resets and more conservative capital deployments from the end of the PEVCs. Can we move on to the next slide, please? Yeah. So this is a more of a Q1 2025 overview. So 2025 began on a very cautious note, we would say rather. In the first quarter of 2025, investments were down by 14% year on year. This could be largely due to fewer large deals, but buyouts, as I mentioned earlier, held strong at US dollars 5.2 billion, while growth and startup investments remain active, indicating a more of a wait and watch approach among investors. Next slide, please. So the slide 7 and slide 8 are largely, trying to upbring us with the current status. On April 2025, you can see a month-on-month coverage. So month-on-month, if you look at it, it's slightly lower in terms of the total quantum, but in terms of the number of deals, it's flattish at around 108 deals, in which largely infrastructure and real estate showed up the activity, accounting for bulk of the value. Can we move on to the next slide? Yeah. So if you look at April is somewhere like, again, this is a year-on-year comparison of April 2025 with April 2024. And as we can notice, it is dipped by around 6% comparatively. The key thing to note here is that the startups have defied the trend and found as a large part of the PEVC activity. So growing roughly around 80% year on year to 1.8 billion, underscoring that there is an ongoing appetite for innovation in the Indian PVC ecosystem. Can we move on to the next slide, please? Yeah. So these are some of the marquee transactions that happened in the traditional sectors as well. As you can see, BFSI continued to have interest from the investors. Next slide, please. Yeah, we can observe that in the technology sector is somewhere which attracted the maximum amount of capital in Q1. And at the same time, it was seconded by financial services, which in Q1 attracted $1.6 billion of investment, as well as 43 deals across. Next slide, please. So these are some of the significant investments that happened. You can see that largely it has been led by buyout in the investment segment, and then there is strong participation from the growth investors as well. Temasek investing around 936 million for 10% stake of Haldiram's. Can we move on to the next slide? Next slide, please. Yeah. So if you look at the exit activities, there has been a strong exits that has been made through strategic exits largely, and if from the IPO market also there has been a strong rebound with the 40+ P that IPOs that happened this year. Next slide, please. So there are some significant investments exits that happened in the Q first quarter of 2025. So total exits were roughly around $8 billion. The marquee transaction that we need to note here is in the renewable energy sector, the green segment, where you can see that NIF and BII were able to make a strategic exit in Ayana Renewables to NGC and NTPC Green. Next slide, please. Next slide. Can we move on to the next slide, please? Yeah, so these are some of the significant exits that happened. As you can see, in the clean tech space, largely it has been renewable energy that has been able to give some strategic exit. One of the larger transactions that happened. At the same time, you can see that strategic exits also formed the bulk of the exits that happened in the first quarter of 2025. Next slide, please. Next slide. So fundraising activity has been on a downtrend since 2022. Although this year Kedara has been one of the, in 2024, Kedara has been one of the largest firms raising roughly around $2 billion, highest ever by an India-based GP. But after recording this record high fundraising in 2022, US funds, of USD 17.4 billion, fundraising has practically significantly dropped across two consecutive sectors. Years, sorry. Next slide, please. So in the first quarter of 2025, as you can see, both in terms of volume as well as the total quantum raised in fundraising has been significantly being up. One of the largest fundraise in first quarter of 2025 has been from ACL. They raising around $650 million for early stage startups in India and Southeast Asia. This shows that there is a continued appetite for innovation in India. Next slide, please. Next slide. Yeah, so these were some of the significant fundraisers that happened in Q1 of 2025. ACL, as I mentioned earlier, raising around $650 million. And you can see across the ecosystem, there is at the same time quite a bit of appetite apart from for consumer tech, fintech. There's also a strong appetite for climate tech where, Singularity being able to raise $211 million for energy transition, next gen industrials, consumer healthcare and financial sector services. Next slide, please. Next slide. So this gives us a brief on the sectoral momentum that we have seen. BFSI, healthcare, infra, and tech were top performing sectors in 2024, where you can see infra and BFSI continue to be one of the top performers even in April, right? And financial services has significantly jumped from 41% to 9 billion, 14% to jumped 41% to $9 billion, right? Real estate posted a record $8.8 billion of investments, highlighting a broader base for sectoral resilience. Next slide, please. So this slide essentially talks about VC and growth investments in the BFSI segment. We can see that BFSI saw around roughly 216 deals in 2024, up by 35% on a year-on-year basis, driven by scalable NBFCs like Vasco, Need, and these firms were filling the credit gaps essentially in tier two markets, right, offering predictable growth. Fintech practically took a kind of a backseat, but at the same time, that is green financing in NBFCs, which saw like almost 5 times the growth. Next slide. Next slide. Next slide. Next slide, please. So on the climate tech, there is a decline in climate no, please go back to the last second. Yeah. Climate tech, there has been a decline in climate investments despite long-term potential. In 2023, there was a PVC fundraise of roughly investments of roughly around 3.4 billion, but that has significantly dropped in 2024, $1.3 billion. And Green Frontier, which is one of the climate tech funds, which has raised roughly around 1,500 crores for its Series A deals. So that has been one of the marquee fundraisers in 2024. And on a statistical point of view, if you look at it, infrastructure has been one of the sectors which has been able to raise a lot of capital, and out of which 33% is largely renewables, right? So this has been the fundraise that has happened in the climate tech space. And climate tech funding has leaned heavily towards EVs, batteries, charging infrastructures, and clean mobility. So that has broadly been the trend. Next slide, please. So broadly speaking, from an outlook perspective for 2025, I think buyouts will continue to gain share as a succession and consolidation themes accelerate. IPOs and public market exits will continue to dominate. Financial services is poised to lead, whereas if you look at climate and infra theme funds, these are more likely to attract fresh capital, especially once the rate cuts kicks in mid-year. I think that is something that has already started. So that's it on the presentation. Thank you, everyone. So now we'll move to the more interesting section where we can have the Q&A with the uh, uh, panel speakers that we have, and we have a very good mix of panel speakers with us. We have Miss Stalin Sharma, who is the founder partner of Green Artha. We have Mr. Harsha, who is the head of equity Asia for Oiko Credit, which is a Dutch fund. And we have Ms. Dipti Agrawal, who is the AVP at IIX. So once we start these Q&A, before that, I would like to thank all the panel members for taking out time for this webinar and getting along on this call webinar to help our viewers with their interaction as well as with the expertise that they are going to provide on the advice front for the viewers. So first and foremost, I would like to start with Ms. Stalin Sharma, who's the founding partner of Artha Ventures. So Stalin, welcome on the webinar. I'm glad to have you here. Can you hear me clearly?
Yes, Gaurav. Thank you for having me here.
Great, great. Before we start, I would just request you to just briefly tell the viewers about yourself and your journey and what you do at Green Artha.
Right. Green Artha is a climate innovation and investment fund that focuses on decarbonizing economic development. So very fundamentally, we are looking at India's larger growth story and the very significant emissions that are associated with that expected growth, and how to ensure that businesses have the tools and capabilities to build right. But we do this by supporting really world-class entrepreneurs building world-class products that are entirely economical and have the ability to really transform entire sectors. So we like to say we're never going to invest in a pair of tennis shoes. We're going to invest in the products that change the way Nike and Adidas make tennis shoes.
Excellent, excellent. Thanks for that brief introduction. So my first question to you is just to get a sense from you, as per your understanding in the climate tech or the climate aligned subsectors, where do you see the biggest investment opportunities in India over the next 2 to 3 years?
When we look at what's happening right now in the larger capital markets, the extreme volatility that's come up due to various geopolitical conflicts, as well as certain government actions from the US that have riled the financial markets, we've really seen that there's kind of been a little bit of a step back from what is happening in the market. However, what we are seeing in India, and like even just this week, I was sitting with various very large ticket LPs who were complaining that they're getting shut out of deals in India. So I think that we're going to continue to see that there's a strong sentiment around particularly infra type projects in climate in India. So any of our renewables, a lot of interest in batteries as part of that renewables package. The EV charging infrastructure is sort of like one piece. But I think when we start looking at where the economy is going and what is getting people excited, we definitively are seeing that there's a very strong interest both in industrial decarbonization. So think new materials, green chemistry, biotech, as well as AI use cases around industrial decarbonization, because they're seeing that there's significant opportunities for energy savings that can come from that. And there's a very clear indicator that when that is happening, there's also an opportunity for businesses to save money. And that's especially important when we're seeing that there's industries that are not able to be grid connected for certain aspects of their operations.
Excellent.
In a long,
Excellent.
like in a long and short summary, I would say that we're going to see continued interest on the industrial side, but we'll also see more increased interest in sort of the innovative technologies that really can economically participate in India's transformation.
Excellent. Thank you. Thank you for a very comprehensive response on that. Moving on, then my next question is to Mr. Harsh Shah, who's the head of equity for Asia for Oikocredit, which is a Dutch-based fund. So, Harsh, before we go on to the question, just a brief about yourself and the fund that you work for and what you guys do, so then we can have the cues later.
Yeah, thanks, Saurav, for having me. Thanks for having this panel as well. It's a discussion at the right time. A lot of things going around in the market. But quickly brief about us. So I manage the equity portfolio for Oikocredit in Asia region. Oikocredit is a Netherlands-based impact investment fund. We have about overall €1 billion of AUM. We primarily focus on three segments: financial services, food and agriculture, and climate. We invest across three major continents: Asia, Africa, and Latin America. And focus on the equity side, we are primarily focused on Series A to Series C growth stage investments. That's a very brief sort of introduction.
Thank you. Thank you, Harsh, for giving us a brief intro. So my question to you is what do you see as the most critical governance gaps in Indian startups or businesses that are raising late stage capital in India, based on your experience and view of the market?
Going to make a slightly controversial statement, which is, I think, as investors, we are also responsible for some of the misgovernance that is happening, across many startups. One of the main reasons is the hunger for growth, or the push by investors for higher and higher growth, and which eventually leads to representation or misreporting on the startup side. Founders are incentivized at times only for growth, and then that's why directly, indirectly, they are incentivized for maybe misrepresenting some of these numbers as well. So I think inflating the revenues has been one of the very key element that we have seen in many startups. Especially in 2022 onwards, we have seen, and of course, not taking into account the Gensol, which is the latest in this continued saga. I think we have not learned as an investor group some of these lessons. Second is obviously the weak internal controls, audit, or let's say the lack of due diligence by investor group itself. I think companies like Gensol, for example, there are very many red flags already present, and then yet I think we as investor group have collectively failed on some of these basic things as well. So that obviously is a major issue. Third is part of financial, but is the related party transactions. And there is sometimes complex web of parent company subsidiaries, and then the transactions that happen within the group companies. And again, this is used to inflate revenues at times as well. There are some of the agri-tech companies where there are buying and selling happens within the same set of buyers and sellers, stuff like that. That happens even within B2B trading companies as well to inflate revenue. So some of these A, related party transactions, or B, pressure to generate higher, or showcase higher revenues in order to raise next round at much higher valuation. So that's leading to um, corporate governance issue, and we as investors need to start fixing them first by first focusing on corporate governance and then focusing on growth.
Thank you. I think that was quite a candid response based on what has been the learnings and observations in the market of lately. Right. Thanks a lot for that response. Now I would like to address to Deepti Agrawal, who is the AVP at IIX. Deepti, I would request you to briefly introduce about yourself and the fund that you work for, and then we can put a question, share a question with you.
Thank you so much, Gaurav, for doing a fantastic job, and I'm grateful to be here. So I work with Impact Investment Exchange, and we work at the intersection of climate and finance. Coming from a traditional finance background myself, doing the CFA and FRM, getting those charters, I worked in traditional finance and had a longing to be in the impact space where, which I get a chance to do at Impact Investment Exchange. We particularly are focused on connecting impact enterprises to the Wall Streets of the world. So how we predominantly be able to do that is through our two arms that we operate out of, which is one, the asset management arm, under which we have two debt instruments that, from which we deploy capital. One being the Women's Livelihood Bond, which is the largest social stock exchange listed on the Singapore Stock Exchange today in the world. And the second one is an innovative finance structure that combines the characteristics of equity and debt to provide patient capital to smaller enterprises to be able to capture them at every stage of their growth. And the other arm that we have is on the transaction advisory side, where we actually handhold these enterprises to be able to raise the funds they need, be it internal or external capital as well. So my expertise lies in working with these startups, be it sourcing for our internal funding or connect them with, investors who are in the climate space or not, be it patient capital or not. So making the right matchmaking for those enterprises and just training them and making sure they're investment ready is more of what my job is. And my regions usually are, South Asia, with a strong focus actually on Southeast Asia now, in Indonesia and Vietnam. So yeah, that's pretty much about me and about what we do here at IIX.
Great. Thanks for covering it and giving a comprehensive overview of your fund. So my question to you, Deepti, is that what's holding back climate tech from attracting the kind of capital that fintechs that once did in India?
Thanks, Gaurav. I think it's a very interesting question. So we have to definitely realize that fintech can promise a unicorn in 5 years, right? But climate tech needs investors who think in decades, and they don't think of exits or there's no short promise of a unicorn, because fintech had a magic recipe. So they had like short return cycles, they have massive TAMs. So the on the other hand, the policy, for climate tech they have a different DNA. So it's not code that you can scale overnight. It's kilowatts, it's molecules, it's megawatts. So I think what you can say is, in fintech you scale code, but in climate tech you actually scale concrete and chemistry. So that's not something that you can imagine doing in the short run. So we definitely need more patient capital. So I think that doesn't hold back, but there's definitely a need for more of these funds to flow in. So we also have to realize that most climate tech models are very asset heavy. and they have longer gestation periods. They rely on uncertain monetization channels, maybe carbon credits or subsidy-linked pricing. So those kind of capital and the scientific conviction requires time and uh, an intersection of innovative finance structures, because only private capital is not enough in this case, just like it is for the fintech, as an entire market. Also, I would just want to also mention that if you want to go far in green, um, especially in the case of fintech, we need capital that's more climate literate, and it's more risk tolerant, and definitely more patience. I think these are the differences. I don't want to say what these are, what's holding back, but I think they are very different from each other, and shouldn't be put together in the same bracket. And I'm sure, Tarveen over here, she is a fantastic professional doing this, every day. So I'm sure she would have more to say about this later on. And yeah, that's from me.
Thank you, Dipti. I think that was a comprehensive response. I believe in the Indian context, when it comes to climate tech, I think the expectation is not only addressing the Indian TAM, but they believe that the tech has to be something which has to be much more scalable and being able to supply to global south largely. That is where the expectations come in, and that with that set of expectations, there definitely needs to be a more of a patient capital that has to be invested in these climate tech funds, climate tech companies. Thank you. Thanks for that response. I would like to come back to Stalin. Stalin, over to you. So my question to you is, considering the current emphasis that is there on the climate risk mitigation, so are the LPs now demanding more alignment with ESG and climate goals when backing Indian GPs?
So I think this is very dependent on the type of LP that you're looking at and the market that they're coming from. And there has been, I would say, actually a significant shift away from this. And it's not just sort of a Donald Trump phenomenon. We were seeing it already before in 2020, 21, 22, when a lot of funds were raising large amounts of capital. A lot of large mainstream funds were raising large amounts of capital. They were being mandated to include a climate lens for at least a portion of their investments. And we actually were selected to set up the Act for Environment Fund partially to make some of those, to make certain types of climate techs investable for the VCs that were making really significant capital fundraisers at the time. We've seen that there have been a number of large-scale asset owners or managers of asset ownership, like BlackRock, that have stepped back from their commitments around net zero. And we're seeing that the people who are being reactive against Donald Trump are definitely looking at ESG or certain aspects of ESG, and I would say particularly mitigation and governance as key factors that they're very keen on, and the governance really being that factor around the ability to get an exit at some point, much as Harsh had suggested. In Europe, you're seeing that, for example, a lot of the LPs are very, very savvy around understanding different types of climate taxonomies. So they're very often not looking at ESG as a formula. And in some markets, even people who are very savvy around climate are rejecting the notion of ESG, thinking that it's being used to greenwash or whitewash activities that maybe aren't as impactful as they could or should be. But the flip side of that is we are seeing, as a response to Donald Trump, Europe is taking a lot more interest in climate and really pushing the agenda there. We're seeing a lot of corporates that are committed to sustainable and cost-effective operations, taking up interest in investing in solutions that are cost-effective. And I would say this just as kind of like a little bit of a thought in terms of what Dipti said. There's a value in saying that we need to get more climate literacy into the asset owners. But the fundamental issue is we also have to meet the asset owners where they're at. So can we find the types of technologies that can give both the types of return profiles that are needed, really meet the requirements of businesses, and do so in a way that's good for the startups, good for the VC, and good for the asset owner in the end. As long as we're sitting around saying, well, the asset owners need to change, we're going to see that there's going to be smaller pools of capital available.
Understood.
Thank you.
Understood. So I think from your point of view, there has to be a good balance in terms of trying to reach the sustainability part of it, as well as the commercial aspects or the requirements of the market, right? So, right.
I would go as far as to say the companies that we like to look at, we look at their ability to make climate impact at a unit level and their economics at a unit level. And we look at those to be both one-to-one in terms of how that grows. However, we would expect economies of scale over time, which would make it so over time we're getting more impact for fewer dollars of investment.
Yes, quite a prudent strategy in terms of deploying capital in this space. Thank you. Thanks for that response. Moving on to Harsh. Harsh, my question to you is on the valuation corrections that are there happening in the market and the increased scrutiny affecting the growth strategies of fintech companies, right? So seeking private equity or VC investments. So how are you seeing that?
I think what we saw between 2021 to 2023 was more of exuberance and FOMO. I think the sanity is now returning to what should have been the valuations in the beginning. So it's a welcome change after 2-3 years of exuberance. But there are one aspect is, I think, Bloom had come up with they've been Indus Valley report, and they clearly defined and very nicely defined as India 1, 2, 3. I think what startups have been making a mistake and what investors have also been making a mistake is how we define as TAM. And we always define TAM as 1.4 billion people for almost everything. And that's not really the TAM. For credit, TAM is probably, a top 20-30 million people in India. For fintech lending companies which target MSMEs, the TAM is probably middle level, which is probably 400 million people. And most of the fintechs are not able to reach the rest of the 1 billion people in the country. So it's really how entrepreneurs, investors have projected TAM and then failed to live up to the expectations of the valuation that were given in expectation of certain growth, which has not been met, obviously, in the hindsight. So yeah, I think overall, it's a good sign, but there is more to come specifically when it comes to lending fintech companies. We are seeing some of the companies might shut down in 2025 because there is a lot of increased stress in the market, especially in the unsecured lending side. And for others, we'll see a lot more muted growth in FY26 as well. So for lending fintech companies, I think the correction has just started, and what used to be about 4.5 times, 5 times book value multiple will come down eventually to 2.5, 3 times multiple, which is what, let's say, public markets will also expect at the time of IPO. So the divergence which was there between private markets and public markets will start correcting from 2025 onwards in the lending NBFC space, lending fintech space.
Okay. So I think summarizing your response, what I essentially understand is the kind of TAM people were thinking that there is there for the fintechs to capture, it's not there. And the rate or the acceleration of the credit penetrations that the fintechs were promising, that is also something that is not happening. And then there is going to be a big value adjustment that is going to come in the next few quarters. That is essentially what you are envisaging.
Yeah.
Great.
Good.
Great. Thanks for the comprehensive response. I would like to address the next question to Dipti. Dipti, you're there on the call? I think there is some issue at Dipti's end. Nonetheless, I think I can address the next question to Stalin. So Stalin, I just wanted to understand from your end, like in the overall April. Okay. Dipti is there, so I can. He
Yes,
has rejoined. Great.
I
Great.
am so sorry. I was just facing some issues with my
No problem.
technology. Yes.
No problem.
Sorry, Gaurav. Yes, you can continue with me.
Sure. So my question to you, Dipti, so from your perspective, can India realistically position itself as a global climate tech hub, given the current pace of capital deployment?
That's actually a great question. So, I think India has all the right ingredients. So to emerge like as a global climate tech hub, so like we do have the policy ambition and we have a vibrant startup base as well. Um, but although we have the green ambition, but we need the greenbacks to match, so that we need the capital to actually come in. So when we look at the numbers, we need about 160 billion US dollars annually by 2030 in climate investment, and we are nowhere near that pace. So we are seeing momentum, but we definitely need to see more of this capital coming in to match the targets we've set for ourselves. So, even though we have some missions in place by the government, there are deals that's happening. Just for example, Battery Smart, they closed over 40 million. I think I'm not too sure about the number, but it was above 40 million in Series B. Then there was Solar Square. So we do have quite a few momentum in place. And as you were taking us through the numbers, I see 2025 has actually done well in this space, especially to do with climate technology. But I think we are struggling with the value of debt. So post the pilot stage where the grant capital runs out and commercial capital isn't ready to step in, so that between those stages is where I feel there's a lack, and there's a serious need of investors to fill in that gap. And we also, I think, to be able to actually develop as a climate tech hub globally, there definitely needs more blended finance structures, so that would de-risk early adoption. So they would bridge the gap, they would offer the vital capital support from public or charitable sources in the form of low interest loans. So if you're giving the same options to the traditional startups as equal to the climate ones, they're not going to do well with the loans that are currently in the market. So subsidizing those loans, providing grants and first loss capital is going to be of utmost importance. And then an ecosystem approach is needed, where we just don't fund startups. We need to build supply chains, anchor those demands, and support the exits of these companies. So I think I would just I would like to end with so if we do get it right, we're not just solving for India. So we have to we're exporting affordable climate technology solutions to the global south, because as more and more the entire global economy is open, they're always going to switch to the lower, cheaper alternatives. So we have to come up with cheaper solutions backed with a narrative and policies that support those growth.
Thank you. I think I could summarize it in a bit. So based on your understanding, we have the right ingredients to do it, but at the same time, there are certain gaps which can be filled in through certain financial institutions, whether it's the impact funds, domestic or international ones, that can fill in those gaps. And at the same time, we can not only provide capital to the startups themselves, but the entire supply chain that comes with it, right? And from that perspective, we will be in a position to provide climate tech solutions which are affordable not only to us but also to the entire global south, right? So that's what I understand from it. Thanks for that response. I would like to move to Stalin once again. Stalin, I think if since Greenatha is one of the climate tech funds, I would like to apart from my question, I would like to know from you if you would like to add anything to what Dipti mentioned on the climate tech hub coming up in India being the climate tech hub.
So I would just say that, I think India has a phenomenal opportunity to become a global leader in climate. From a governance perspective or a global relations perspective, India has always been a leader to the rest of the global south. But I think the piece that's much more exciting is we're seeing with a lot of the technologies that have been coming up, it's not just India exporting to the global south. We're seeing in India exporting to the global north, right? In our portfolio, we have companies that are working with Nike and Adidas and Hindustan Unilever and Procter and Gamble, right? So we shouldn't be limiting ourselves to the idea of the global south. Indian innovators and entrepreneurs are technically exceptionally savvy. I fully agree with Dipti that we have to provide certain types of support. Certain aspects of the education system limit how much very strong technical engineering students are exposed to economics or business during their studies. And so very often there is a need for certain hand-holding around that. A lot of the entrepreneurs that are coming up with these technical solutions, we're seeing them bucket into two sorts of groups. One is career professionals who have been in an industry and they're solving for that industry. Others are young folk who are coming up from the universities and coming up with really strong technologies. The first group is very savvy in terms of how they interact with business and coming up with a very viable and cost-effective business case up front. The latter, we often need to work with them on things like pricing and what does a commercialization cycle look like if you're going to work with industry. But we've hands down found that, dating back to like 2010, 2015, climate entrepreneurs in India are working with scenarios of scarcity. And so while we absolutely need more money because this is a very much time-bound problem and we can't wait 10 or 20 years to solve it, we do have entrepreneurs that are working in this that have been used to working with scarcity. So they are able to build these models that are, I think, very effective when they have the right type of capital. And so when we bring that capital in, we're going to be able to see very significant impact coming from climate mitigation and business solutions that make business sense.
Understood. So I think that's quite an interesting take, quite a different approach as well. So my question to you would be on the exits, right? So April 2025 records somewhere around 12 exits, right? So what signals do you take from the current exit rot in the Indian PVC space? What could be the plausible reasons for the lower number of exits from your point of view?
So I think that there's really kind of three factors here. The quickest and most obvious is it's been a very volatile period, and whenever there's high volatility, investors like to sit on cash and see how things pan out. Valuations come down, and so startups are going to be or companies are going to be less likely to want to pursue an exit. A second factor is you're talking about April, which is always a very low month for exits. People like to get them done either before the end of the fiscal year, or they like to wait until the fiscal year numbers have been finalized. So you typically see a lull from like April till, sort of June, July anyways. But I
Yes.
think, and this is gonna go back to Harsh being quite candid, I think part of the issue with exits is also that when you see markets contract, it really comes back to a question of, are we entering these startups at the right valuations, right? The question is never like, is the exit valuation right? That is always just a function of what is the entry valuation, right? The exit valuation is a market price. If somebody's not ready to buy, you're at the wrong price. Which means that if, you know, the current valuation is, we'll say 100, and the valuation you entered was at 100 and it's been 5 years, you're looking at a negative or a negative return. That's because you entered too high, or the market has had fundamental shifts, right? If you entered at 80, you'd be okay, happy with where you're at from a return perspective. So, you know, I think that there's a really significant importance in taking the time to get into the fundamentals of the businesses that we're looking at. And that's particularly true when you're looking at climate businesses that very often need access to capital and have to think about debt as part of their capital stack. It's also very true when you're looking at fintech businesses where you really have to see asset quality on the lending side.
That response gave a complete overview, both from the operational point, both also from the practical standpoint, and also from the cyclical nature of the macros and the overall market. So thanks for that complete response. My next question is to Harsh. Harsh, from you, I would like to understand that, you know, MFIs right now in India have witnessed some rising delinquencies, right, in the recent past. So has this had any visible impact, according to you, on their ability to attract private equity or VC funds? Is largely from MFIs in India's perspective, from that perspective.
Yes, I think in last 24 months, last 12 months, there has been only one transaction, that too also from a DFI to one microfinance company. Otherwise, in last 12 months, no new money has come in this sector, and that's primarily to do with the increasing credit costs that we have seen. Of course, I'm not counting the rights issue by a couple of listed entities which have attracted some capital. But otherwise, no new investments have happened within the sector as such. And the primary reason was nobody knew where the bottom lies. Now, as it seems, I'm just coming back from a field visit in Eastern UP, and seems like there are very early signs that yes, things are returning back to normalcy. At least for the regular paying customers. There are some customers which are not paying, obviously, and that forms like anywhere between 5 to 20% of the portfolio for microfinance companies nowadays. There, the recovery rates will be slower. But for the remaining, that's 80 to 90% of the customers, they are paying back as they were before the crisis started. So, from opportunistic PE point of view, I think this is the right time to enter. As we speak, RBI has also just announced some regulatory changes which will make the sector more attractive as well. So it's a very opportunistic buy for a private equity investor, more commercial. I would say I don't think many impact investors will be looking at microfinance as a sector as such. But at least the private equity investors who can come in at a right valuation and can still exit, because it's a cyclical business very much, and we are seeing this cycles every 4 or 5 years nowadays in microfinance companies, can actually make a smart entry point and exit at the right price.
Thank you, Harsh. I think that was quite a comprehensive response, covering, you know, what the recent state is for the MFIs, right? Thanks a lot. So my next question is to Dipti. Dipti, from your perspective, if you look at investors, right, so how are they looking to, you know, balance the scale on sustainability in India, especially in the maturing startup ecosystem?
Thanks for that question. I know we are almost at the end of time, so I
Yeah,
won't
thank
take
you.
much time to answer this question. But um, I just want to say, I think these days, especially with the startups I've worked with, there's definitely a need, and investors in India are actually increasingly recognizing that sustainability isn't just a trade-off against scale, it's a multiplier. So if your startup can't pass a climate audit, forget about passing due diligence. So as the ecosystem matures, there's actually a shift from growth at all costs to growth with consciousness. And that's why ESG factors are now just not seen as risk mitigants, but actually drivers of long-term value creation. So, for example, companies like Gravity Labs, Patcare, and in fact, Zero Circle, which is, I think, one of the portfolio companies for Green Artha, who we've assisted in the past as well. They recently got an odd. I mean, I just recently saw Swiggy delivering via the Zero Circle packaging, right? So it's not the just climate technology investors or only companies having those social or climate focus. These are regular, like Swiggy is the most. I mean, of course, they do have their practices, but it's a regular traditional business operating with having an option for having those packaging supplied by Zero Circle. So these startups are just not now in their own categories, but also expanding to get adopted in commercial businesses and models. So investors are starting to see that. So now, I would just end by saying, and the India's startup ecosystem is definitely maturing, and just like a good investment, the maturity is coming with discipline. So that discipline actually includes carbon, circularity, and community impact, because along with investors, consumers today are more and more demanding for transparency and do want to see. I will, pass it back to you now, Gaurav.
Thank you, Deepti. I would like to ask Starling if you would like to add to that because we're just closing on as a last question.
No, that was great. Thank you.
Okay, great then. Thank you, everyone. Thank you, Harsh. Thank you, Starling. Thank you, Deepti, for taking out time for this webinar. It has been wonderful having you guys on board for this webinar. Thanks a lot.
Thank you.
Thank you.
Thank you so much.